Fixed income. Fixed income in CFA Level 2 focuses on advanced bond valuation, interest rate dynamics, credit analysis, and risk management techniques used in institutional investing. Candidates study the term structure of interest rates and analyze the relationships among spot rates, forward rates, yield curves, and expected bond returns. The curriculum explains how changes in benchmark rates, yield spreads, and yield curve shapes influence fixed income security prices and portfolio performance. Candidates also examine theories of the term structure, including expectations theory, liquidity preference theory, and market segmentation theory. Understanding these concepts enables analysts to interpret economic conditions, forecast interest rate movements, and manage duration exposure effectively. Fixed income forms a critical foundation for portfolio construction, risk management, and the valuation of debt securities in global capital markets. The curriculum emphasizes arbitrage-free valuation as a core framework for pricing fixed income securities. Candidates learn how zero-coupon yield curves are constructed through bootstrapping and how arbitrage-free models ensure consistent valuation across securities with different cash flow structures. The curriculum introduces binomial interest rate trees and backward induction methods used to value option-free bonds and securities with uncertain cash flows. Candidates also study Monte Carlo simulation techniques and term structure models for evaluating complex fixed income instruments. These methodologies strengthen understanding of how market participants price securities under varying interest rate scenarios. Arbitrage-free valuation is especially important because it provides a mathematically consistent framework for evaluating fixed income instruments and managing interest rate risk within institutional investment portfolios. Valuation and analysis of bonds with embedded options represent another major area within fixed income. Candidates study callable bonds, putable bonds, convertible bonds, capped floating rate notes, and other structured securities containing embedded options. The curriculum explains how embedded options alter bond cash flows and affect valuation, duration, convexity, and price sensitivity to interest rate changes. Candidates learn how interest rate volatility influences option values and option-adjusted spreads. Effective duration and key rate duration measures are introduced to evaluate interest rate sensitivity for securities with nonlinear cash flow behavior. Understanding embedded option analysis is essential because many fixed income securities contain features that significantly influence risk and return characteristics. These concepts improve the ability to evaluate structured products and manage portfolio interest rate exposure more effectively. Credit analysis is a critical component of the fixed income curriculum because credit risk directly affects bond valuation and investment performance. Candidates study credit ratings, default probabilities, expected exposure, recovery rates, and credit valuation adjustment concepts. The curriculum compares structural and reduced form models of corporate credit risk while examining the determinants of credit spreads and the term structure of credit spreads. Candidates also analyze securitized debt instruments and compare their risk characteristics with traditional corporate bonds. Understanding credit risk enables investment professionals to evaluate the financial strength of issuers and assess compensation for default risk. Strong credit analysis skills support fixed income portfolio management, risk control, and investment selection across government, corporate, and structured debt markets. Credit default swaps are introduced as important derivative instruments used to transfer and manage credit risk exposure. Candidates study single-name and index credit default swaps, credit events, settlement mechanisms, and market pricing principles. The curriculum explains how CDS contracts are used for hedging, speculation, and relative value trading among bonds, loans, and other credit-sensitive instruments. Candidates also examine how changes in credit spreads influence CDS valuation and portfolio risk. Understanding credit derivatives is increasingly important because they play a significant role in modern fixed income markets and institutional risk management. These instruments allow investors to isolate, transfer, and manage credit exposure independently from ownership of underlying debt securities, thereby improving portfolio flexibility and strategic positioning. Overall, fixed income in CFA Level 2 develops advanced analytical and quantitative skills necessary for evaluating debt securities and managing interest rate and credit risk. The curriculum combines valuation theory, yield curve analysis, arbitrage-free pricing, credit modeling, and derivative applications into a comprehensive framework for fixed income investing. Candidates strengthen their ability to interpret economic conditions, evaluate structured products, and construct diversified bond portfolios aligned with investment objectives and risk constraints. The topic also reinforces the importance of understanding market liquidity, volatility, and credit conditions when assessing fixed income opportunities. Strong mastery of fixed income concepts enables investment professionals to make more informed investment decisions and effectively manage risk in increasingly complex global debt markets.